Welcome everyone to today's MoneyShow's Accredited Investors Virtual Expo and our next presentation. My name is Natasha and I'm your host. I am pleased to introduce Rick Rule, founder of Rule Investment Media. Rick began his career in 1974 in the securities business and has been involved in it ever since. He is known for his expertise in many resource sectors. He has originated and participated in hundreds of private placements in over a 40-year career. Today, he will be discussing private credit. There will be time at the end of the presentation for questions. Please type them in the chat and I will present your questions. Thank you so much for joining us, Rick. We look forward to hearing from you.
Natasha, thank you for that kind introduction. And good afternoon, ladies and gentlemen. I'd like to extend my thanks to all the staff of the Money Show who have done a great job maintaining their physical conference franchise with these wonderful virtual conferences that they've been able to ad lib over the course of these strange COVID-induced times. I've spoken to this audience numerous times about private placements, and most of the discussion has involved privately placed equity, which is to say shares or direct ownership, equity ownership in various businesses. Given the fact that there's a whole different side of private placement investing, in fact, a whole different side of investing, which is based around income, I thought I might talk about private credit too. We've seen increasing demand for private credit advice and private credit products, which makes perfect sense as the accredited investor community ages, which is to say they come to look more like me. Stable income has become an important investment goal. Stable income has become an important investment goal precisely at the time that it's become less easy to obtain it. The very low interest rates, I would argue artificially low interest rates that are a consequence of things like quantitative easing and yield management, has meant that making a return on your savings is something that has become increasingly difficult to do. And I suspect will be difficult for as much as 5 years hence, as there is more political than market control on the interest rate. As to the sense that that might change, I think people need to understand that one function of a democracy is in fact a war on savers by spenders, spenders being more numerous. The current interest rate policies, which of course penalize spenders, are extremely popular with savers and as a consequence, politically expedient. So I see them continuing. In the face of it, as I say, we have a circumstance where more and more investors are needing to generate yields on their savings at the same time that society itself perceives that it can't afford to generate yields on savings. Let's look at the world's preeminent savings instrument so that we can get some sense of the arithmetic around conventional savings products. Throughout my career in investments, which goes back to 1974, the world's benchmark security, the one against which all others are priced and judged, is the US 10-year Treasury. If you look at the investment attributes of the US 10-year Treasury from an arithmetic point of view, the problem facing income investors today is sort of demonstrated. The yield today on the US 10-year Treasury is somewhere around 120 basis points, 1.2%. So in other words, if you give the government money, they will give you 1.2% on your money for 10 years. This in a currency where the purchasing power of the currency, according to your government, is decreasing at 4.5% a year. In other words, they give you 1.2% while the purchasing power of your savings is going down by 4.5% a year. My friend Jim Grant refers to this as return-free risk. Return-free risk is not a particularly exciting alternative, but the need for income is very, very, very real. The consequence of this is that there is increasing interest, in debt products structured for private placement investors that yield higher yields. Why would issuers go to the private placement market to begin with? That's simple, lower costs. Be it sponsors or be it, issuers, access to the private placement market most often involves an offering memorandum and less ongoing bureaucratic red tape, which lowers the cost of the instrument both to the issuer and also to the investor. Some of this we might expect to be flown through in terms of higher yields. When most people think of debt instruments, they think naturally of bonds. And I must say, I've been a bond investor myself for about 45 years. A couple things have happened in the bond market, the public bond market. One, as the quest for yield has grown, the yields on publicly traded bonds or even privately placed bonds by public issuers has fallen so low that, in my view, the risks outweigh the rewards. The fact that the junk bond index in the United States, that is the riskiest class of public debt instruments, now yields less than the CPI stated rate of inflation is a very odd circumstance to me. The idea that you would take credit risk for a yield that was below the rate of inflation makes absolutely no sense to me. So I and many other investors like me have begun to look for private alternatives. What form of private alternatives? Well, in the first instance, there are numerous sponsors around the world who are offering up various types of private credit alternatives. They may be first or second mortgage funds on real estate. They may be privately placed production credit facilities in the oil and gas business. They may be the products offered by my former employer, Sprott, which has a variety of credit products aimed at the mining industry. There are a whole variety of private credit products, not to mention issuer-sponsored partnership or trusts that are multi-industry trusts, meaning that a sponsor either has or pretends to have enough expertise across multiple industries that they can aggregate capital from investors and allocate that capital to numerous issues, thereby allegedly reducing the risk as a consequence of less concentration in one industry. For myself, I have decided that specialization is much better than generalization. I think the risks of not knowing an industry are greater than the risks of concentrating in that industry. So I would suggest to the people that are listening to this call that, to the extent that you're going to buy a sponsored product, or for that matter, to the extent that you're going to buy a debt instrument directly from the borrower or the issuer, that you be fairly industry specific, which is to say that you invest in an industry that you know, or invest in a sponsor that you know, where that sponsor knows that industry very, very, very well. Lending is an interesting project. You don't take interest rate risk. Pardon me, not interest rate risk. Pardon me. You don't take equity risk necessarily, but you take principal risk. And to the extent that your upside is capped, which is to say, the equity holder gets the upside traditionally in a project, given that your upside is limited, your downside should be limited too. One thing that you learn as a lender is that one bad deal can wipe out all of the returns that you enjoyed on 10 good deals. So while on the face of it, these are less risky alternatives, there are still risks, and risks can play havoc with rewards, particularly because your rewards on the upside are capped. Once again, know your industry. Secondly, know your structure, know the deal. One of my complaints these days with the bond market is that the covenants I see on bonds that are being issued in both the mining and the oil and gas business, industries that I know very, very, very well, are covenant light, meaning that the restrictions on the issuer, the security that you are holding as a lender, are becoming increasingly restrictive. And I don't mean restrictive to the issuer, I mean restrictive to the creditor, which is to say the bondholder. The incredible demand for yield that we have seen in the market has meant that investors in publicly quoted bonds have become increasingly less disciplined in what sort of security that they are willing to take. And of course, the Wall Street advisors are happy to oblige them in their foolishness for a fee. Don't make this same mistake privately. it's important that you and or your sponsor understand the covenants and restrictions that are available to the lender in a loan. This is your security as much as anything else. The covenants, conditions, and restrictions in the bond covenant are your protection against borrower misfeasance or borrower malfeasance. And when I say know your industry well enough that you know whether these covenants do in fact afford you sufficient protection. I guess I'd like to talk about several different types of opportunity that are available. The first is that numerous public issuers, small cap and micro cap issuers, don't have access to formal credit markets, which is to say they are too small to attract bank financing. The credit that they have in place is too small to go to the bond market. So they are forced, to the extent that they want to use debt on their balance sheet, into the private market. And these instruments can be convertible preferred instruments, which are hybrid debt equity instruments, or they can be much more straightforward debt instruments. The variation in instrument really is limited only by legislation and the creativity of both the lender and the borrower. I have been active in this form of private credit, particularly in mining and oil and gas, for 45 years, and this sector has been very good to me. In fact, if you look back 10 years on the balance sheet of my former employer, Sprott Inc., during the 2011 to 2019 bear market in natural resource equities, where the equity index around the junior resource markets, the Toronto Stock Exchange Venture Index, while that index lost 90% in price over a 9-year time frame, the on-balance sheet internal rate of return that Sprott enjoyed from their natural resource lending business was 15% compound per annum. 15% compound per annum is a very, very, very healthy rate of return. And this wasn't attained without courting some risks. While 15% per annum compounded is attractive on a standalone basis, if you compare it with the returns that equity investors enjoyed, if that's the right phrase, which is to say a 90% index loss, the advantage over time of lending as opposed to equity becomes clearly in focus. And my suspicion is that as we increase regulatory constraints across equity markets and across debt markets generally, that the attractiveness to both issuer and lender in private placement markets will continue to increase. This can take many forms. Some structures might involve, as an example, providing credit for building mines. This is something that Sprott has done a lot of. Think of it in real estate terms as construction finance. One area that I see as being particularly lucrative going forward will be after the construction is done, when the mine attains nameplate construction, which is to say after the mine begins to generate revenue and has been de-risked, providing takeout financing. It's not uncommon for the interest rate charge on construction financing to be between 12 and 15% with upside kickers. When the project is de-risked by economic completion, obviously the interest rate should decrease too. But in amounts less than $250 million, the credit available for these takeouts currently doesn't exist in the market. And I would suspect that a very large market is going to develop for non-investment grade takeout financings at yields that are substantially higher than those offered in the junk debt market, but also with substantially better collateral. A better deal for the borrower, a better deal for the lender, a better deal for everybody. What to look at in these circumstances? Well, in lending, it goes like this. Collateral. That's what it's all about. When I was in school, there was the 3 C's of credit, which is character, credit, and collateral. I used to joke that in microcap markets, all the borrowers were characters. So none of them got any particular marks for that. None of them had any credit. None of them could go to the bank or they wouldn't come to me. So it all got down to collateral. You or your advisor really needs to understand the value of the collateral and who you could sell that collateral to if you had to foreclose, if your borrower began to wobble. It's important to understand something about loan to value, and it's important to understand what the value of the project will become when the capital that you have lent against the project is deployed. So remember this: collateral, collateral, collateral. Beyond that, you do need to look at the people, however. You cannot foreclose on the people, obviously, but the ability to beneficiate your collateral, the ability not to waste the money that you lent them, really comes down to people. These people should have existing successes, and that success should be very closely related to the task at hand. If these people have been successful explorationists, but they're proposing to build a mine, as an example, those skill sets aren't necessarily compatible with the task at hand. So you want to have a management team where their resume gives you confidence that they can deploy your capital correctly. You want, too, to constrain their access to further credit. If somebody has borrowed an amount of money that seems reasonable given the value of the collateral, but you give them the ability to borrow more money after you have lent your money, what you're doing is impairing your access to credit, even if you're in first position and they're in subordinate position. So I would ask anybody who is lending money in this circumstance to consider making sure that borrowers cannot subsequently borrow more money and impair your access to collateral. Two, I think an important consideration going forward is to understand that the natural direction for interest rates in a free market, not that a free market will necessarily prevail, but the natural direction of interest rates in a free market is higher. For that reason, I suggest that most lending instruments should be floating rate instruments based on some cost of funds. I generally use Libor, which is the London interbank rate. So really depending on the risk that you're encountering with the obligation that you're buying, you should be lending money at a premium to Libor, but a floating rate premium to Libor, so that if the market interest rates go higher, your interest rate automatically readjusts higher too. I think in the current circumstance, this is important. I think it's important too to understand that private credit normally is issued to people that don't have access to formal credit, which is to say bank credit or other forms of credit. And what that means is that in addition to being illiquid, this form of lending is generally riskier, which means that your returns should be higher. It is common, very common, to receive equity kickers or some form of kicker, some form of bonus, so that you participate in addition to the coupon in some portion of the upside that the issuer enjoys. This is attractive, but not necessarily mandatory, depending on the level of interest rate that you're going to receive for making the loan. This hasn't been meant to be necessarily an exhaustive survey of private credit. Those of you who have heard me speak before know that I've probably covered various forms of private equity investments in this forum 5 or 6 times, but I intend to, provided that the people in the Money Show allow me, to dwell more deeply in private credit in future accredited investor forums on the Money Show. I will tell you a few of the forms of private credit transactions that I have been involved in very recently. They include production-based loans for oil and gas companies, revolving production-based loans. As the banks have moved out of the revolving credit facilities in the oil and gas business, particularly in the United States and Canada, there has been increasing room for private individuals and aggregations of private individuals to replace the banking syndicates in making production-based loans in the oil and gas business. Separately to that, I have also been financing royalty acquisition, both in the oil and gas and mining space. Royalties are particularly attractive because you have no sustaining capital investments, and you bear no risk with regards to operating costs. So I've been active for 2 or 3 years in financing the acquisition of royalties by entrepreneurs who are familiar with the space. Sprott has, with my assistance and my participation, financed literally billions of dollars of lending in project finance, lending the money necessary to build out a mine after a feasibility study has been established. It's been a very lucrative business. But as I say, increasingly, I see the opportunity in takeout financing after these mines have been built and they've been de-risked, coming in and replacing the construction facility with a 5-year or so takeout facility after the project has been substantially de-risked. I've also very recently become active in real true asset-based lending. In my case, lending money to high net worth investors to buy physical gold and silver, where the physical gold and silver remains in their name, but is stored in a third-party facility with me having a lockbox feature, which is to say they can't sell the gold until they pay me off. This way, they maintain title to the gold, I maintain collateral. They have the ability to buy more gold than they would with the stated amount of money that they went into the arrangement with. And I enjoy a nice interest coupon with collateral, that is to say gold at attractive loans to value, that make me comfortable lending my money in this very, very, very strange environment. I want to leave plenty of time for questions today, so I'm going to leave you with 2 reasons and ways to contact me. In the first, many of you are already natural resource investors, or you wouldn't be looking to me. Or listening to me, pardon me. Secondly, many of you, in addition to being interested in income or equity investors, I would be delighted to rank your natural resource investment portfolio, your equity portfolio. All you need to do is go to a web form, sprottusa.com/rankings. List your natural resource stocks, and I'll comment on, I'll rank those stocks 1 to 10, and I'll comment on those stocks if I think I have any knowledge concerning the issue that might be useful to you, pardon me. Secondly, although I'm not any longer an investment advisor and I can't offer up any specific advice, I am happy for anyone who cares to tell them more about the opportunities that I've been investing and where they can learn more. If you're interested in that, the best thing to do is email me directly, rick@ruleinvestmentmedia.com, rick@ruleinvestmentmedia.com. Note that I am not sponsoring any debt-oriented investors. I'm not a broker. I can't give individual investment advice. What I can do is tell you what I'm doing and, where appropriate, tell you how you can get more information around that. Ladies and gentlemen, it is as always a pleasure talking to you, and I look forward to interacting with you. And in the time I have remaining, I would be delighted to answer any questions that you may have.
Okay, thank you, Rick. And here's your first question. If I may ask an off-topic question, you have recently commented that during your reviews, you have noticed many portfolios that too heavily are reliant on precious metal equities. What other sectors should be included in a well risk-reward juxtaposed natural resource portfolio?
Very good question. Often people who are attracted to the precious metals narrative go all in. I've seen circumstances where people had 100% of their portfolio in precious metals and precious metals related equities, which is, I think, very dangerous. So directly answering the question, I'm particularly attracted to the oil and gas business right now. If the oil price holds up above $60, which I believe it will, although it might dip below there for months at a time, oil equities in North America, particularly the mid-cap oil equities in North America, seem very, very cheap to me. But I wouldn't discourage, for the right investors, income investors, investments in things like Exxon and Chevron as well. Less upside, but less downside, decent current yields. I think too, if we have a circumstance where we slip into recession later this year or early next year, I'm not saying that we're going to, But if we did, and the base metals companies came off in price, I think it's almost certain that we will begin to experience 4 or 5 years out shortages in a range of industrial materials, meaning that the price escalation that I see in those businesses won't be as much demand driven, but as supply driven. So I wouldn't discourage investments, not currently, but investments if we saw a recession that saw a stock market sell-off in the biggest and best natural resource companies on the planet.
Thank you. And what royalty companies would you recommend we take a look at?
As equity I'm sort of leery about that. Equity investors, unless they know a lot about the sector, should confine their investments to the biggest and the best. This is not investment advice, but those names that one might study would include names like Franco-Nevada, Wheaton Precious Metals, Osisko Royalty, and Royal Gold. Speculators who had more familiarity with natural resources can come down a tick to names like Sandstorm, Altius, and names like that. There are lots of other names that one could consider, but the risks are higher and the expertise required to analyze them would be higher too. I would suggest that for most of the listeners here that you do this in conjunction with a financial consultant who you know has the expertise to understand these smaller issuers.
Well said. And here's a question. Why would high net worth individuals need loans to purchase metals?
There are some number, fairly small number of high net worth individuals, by high net worth individuals, let's say a $20 million person, who wants the financial stability associated with gold, but although they have a high net worth, don't have a high liquid net worth. In that circumstance, an investor may want to have 10% of his or her net worth in gold, which is to say $2 million if they have a $20 million net worth, but only feel comfortable having $1 million up because of other needs for cash. In that circumstance, the investor might put up $1 million of theirs, borrow $1 million from me, and as a consequence of that, have a $2 million exposure to gold, which is 10% of net worth.
That makes perfect sense. Thank you. And is Libor going to be continuing in the future?
If Libor doesn't continue, there will be various interest rate products that one can base off. In the United States, many times people use the so-called Fed cost of funds, or they base their loans at a premium to the prime rate, which is published weekly in Barron's. I prefer Libor because many of my borrowers aren't US based.
Right. Right. Okay. And a couple of people have said thank you very much, Jennifer and Raymond. And I'm just waiting for any more questions. While I'm waiting, do you have any final thoughts?
Well, once again, if people have questions afterwards, or if they're interested specifically in what I'm doing, we had half an hour to talk about a subject that could probably take a year. I'm available at rick@ruleinvestmentmedia.com, and I'm happy to take people through in somewhat more detail what I'm doing with my own money, with the caveat that this isn't investment advice.
It's just a friend sharing, right?
Correct.
Yes. Okay. Thank you. I did type that in the chat, rick@ruleinvestmentmedia.com. And I'd like to thank you and everybody who joined us today. Oh, here's one more question before we go. I can see it popping in. What are the best ways to play coal as a contrarian speculation?
The safest way to play coal is probably to buy Glencore, which is a multi-commodity company that has doubled down on thermal coal. There are more leveraged ways to play coal, but I don't have the courage to talk about them in a public forum like this. Investing in coal really means that you have the courage to go against the political class, against the media, against the academy. And in this circumstance, what you want is the largest and lowest cost, most safe and secure issuer that you possibly can.
That makes perfect sense. Okay. All right. Okay, well, thank you very much for your time today, and I enjoyed it, and I'm sure our audience did. Thank you, everyone, for joining us today.
Natasha, thank you for hosting.
Have a great day, everyone.